Welcome to the Michael Yardney podcast. Today I'm going to be discussing a question that almost every property investor thinks about at times. How long is it going to take for my investment property to cover its costs? Now, we all know that property investment's a long-term game, but it's easy to get frustrated when you're pouring money into your investment and not seeing immediate returns. So how long should we be prepared to wait? And what can you do to speed up the process? That's what I'm going to be asking my guest today, independent financial advisor and property expert Stuart Wemyss, Director of Prosolution Private Clients. So if ever you felt frustrated by the ongoing expense of your investment property, or you're just wondering, are you on the right track? We're not going to let you down. So let's get started with today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
The question many property investors ask themselves is, when will my property investment start to pay for itself? We all know that property is a long-term game, but understanding when you can expect to reach the break-even point, that's pretty important when managing your finances and staying motivated along the way. So to help us unpack this, I'm joined by my regular guest, independent financial advisor and property expert Stuart Wemyss, Director of Prosolution Private Clients, to share his insights. Hi, Stuart.
Hi, Michael. Thanks for having me back.
Well, Stuart, I enjoy your Investopoly podcast and blogs, and recently you wrote a blog tackling this very issue, shedding light on the real timelines it takes for property to cover its costs and what you can do to speed up the process. Now, we know a lot of people look for cash flow in property, and that points them into a particular direction in the sort of properties they buy. But I know you and I believe that residential real estate is basically a high growth, relatively low yield investment. And if you buy a quality asset, an investment grade asset, it actually does take up your cash flow. It is negatively geared. So is it even possible to buy a property that's going to give you cash flow up front?
Is it possible? It might be possible. I think it's improbable. If you think about all the costs, and particularly where interest rates are set at the moment, it's got to be yielding probably 8 to 10% for it to wash its own face in terms of that's just being neutrally geared. And that's assuming
I guess it, of course, sorry to interrupt you, Stuart, depends upon whether you're financing it or not. So maybe we should say that no particular property is negatively or positively geared, a negative or positive cash flow property. It really depends upon how you finance it. And in general, investors use the benefit of leverage as well, don't they?
Exactly right. And that's our contribution towards the investment. So typically we'll go and borrow the full cost, including stamp duties and whatever, of the acquisition. And then our investment is the holding costs over that period of time. So if a property costs us $20,000 after tax per year, and let's assume nothing changes, I'm going to put $400,000 into that property over the next 20 years in terms of holding costs. Now, what we hope is that in 20 years, we'll go and sell that property, pay a little bit of capital gains tax, and my return will hopefully more than outweigh the 400,000, hopefully by a big multiple. That's the strategy, if you like. So one, we should go and buy a really good quality asset. And then two, we should try and minimize the holding costs as much as possible. But we don't want to minimize holding costs or focus on that at the acquisition stage. At the acquisition stage, it's all about the quality of the asset. And if we can spend more money on the underlying land rather than the improvements that sit on that land, it's likely then to deliver a higher capital growth rate. But the consequence of that is it tends to deliver a lower rental yield. That's fine in terms of let's make that acquisition and buy that specific property. But once we've bought the property, then our focus should change to, okay, how do we minimize the holding costs over time?
Well, I know you've got an accountant background and you love numbers and figures and evidence. And in your blog that I'll leave a link to in the show notes, you've done some figures. How long does it typically take for an investment grade property that we're talking about to cover its costs? And what are the biggest factors that unpack this timeline, how long it takes?
Yeah, it's a great question. And really, maybe I'll talk about, why it is an important question to consider. Because really, from my perspective, if I'm entering into retirement, I don't necessarily want my property portfolio to be generating a lot of income. I mean, it's not as we've spoken about, it's not a heavy income style asset. After you pay for all the running costs of the properties, and then you pay a little bit of tax, you might pay some land tax. Once you pay for all those sorts of things, and then maybe you get some maintenance every now and again and some improvements, it's not going to throw off a lot of income. But what I don't want when I go into retirement is, am my property portfolio costing me a lot of money? Because you don't want to have that strong negative cash flow, but also you don't want to have a large sensitivity to interest rates either. You don't want to be in retirement worrying whether the RBA is going to hike rates next month and you've got to cancel the holiday. You don't want to be in that situation. So that's why it's important to consider, how a property's holding costs will change over time, because that will then inform you about whether you need to do anything to deal with that issue. And better to know about it today rather than, wake up in 20 years' time and go, oh, hang on, this portfolio is still costing me money. You haven't left it too late, but you're better off to be on the front end of this. The other element to really think about is rental growth and rental yields. And it's something that I've been grappling with for a long time. If you go back and have a look at median house rental yields in the 80s, they were much, much higher. And I'm sure, Michael, you could speak to this as well. If you chart it, that the rental yield has been in decline. It declined through the 90s and early 2000s. And part of that obviously is because the property growth was so strong during that period as well. So naturally, of course, as a percentage of value, it's going to decline. Rental yields have been pretty stagnant for last 10 to 15 years. So they're not declining, or certainly not declining at the same level. But that's the thing that we need to really think about. Like, if our property values are going to grow significantly, can people still pay 2%? If it's a house, 2.5%, whatever the yield might be, can they afford to pay that? And you look at the long-term growth in rental incomes, like in terms of how much the median house is letting out per week, the long-term growth rate's about 4.3%. So really, if our properties are growing at 7%, but our rental incomes are only growing at 4%, then our yield is going to compress, which means that in 20 years' time, we're not getting 2.5%. We might be getting, 2% or 1.7 or something like that. We've got to think about that as well and how that impacts our cash flow. So look, I looked at just an average property yielding 2.5%, 6% interest rate, which is a little bit lower than what it is today, but I think that's a good long-term average to use. And 35% of gross rental income for costs, for maintenance and property management, council rates, all those sorts of things. And the property didn't start turning neutrally geared until about, plus or minus $1,000 or $2,000 a year, until about 25 years. So you had to hold that property for 2.5 decades before it's not going to cost you very much to hold, which means that if you want to retire at 60, you've got to buy that property at 35, and then you don't need to do anything. It'll be fine. So if you own property today and you're older than 35, chances are you're going to then need to think about, how will my property cash flow behave by the time I get to retirement, whatever that age might be, and whether there's any changes you might need to make today to accommodate that so that the property is at least neutrally geared.
Well, in my mind, capital growth and therefore rental growth are going to be critical to speed that up. I think over the next year or two, everyone agrees interest rates are going to come down and affordability is still going to be an issue for some. So I think choosing the locations that are going to outperform the averages is going to be very important. And I know you've spoken and we've both spoken about choosing locations where people's incomes are higher than average, growing faster than the average, which is going to give them the ability to buy properties, renovate their properties, new people coming in, gentrifying the areas. And that means they're probably going to have a number of streams of income, not just wages income, but maybe business income, shares, other dividends. But I think that's also important to understand the demographics of your tenants, because in the future, your future income is going to be dependent upon your tenants' ability to keep paying rent and keep paying higher rents. And that's why I again like buying properties in gentrifying more affluent suburbs rather than in the outer suburbs where people are really 1 or 2 weeks away from broken. It's not as likely that they're going to be able to afford to pay more for properties in the locations or pay higher rents, Stuart.
And the tenant profile sort of informs you about how difficult that property might be to manage and hold. You know, if you've got some tenants that are really living week by week, they can be challenging. Whereas if you've got some tenants that are in a different economic position, quite often, at least from my experience personally and professionally, they tend to be pretty hands-off and easy tenants. They tend to look after your property. There's no rent defaults. They pay on time, all those sorts of things. You know, we talk about rental yields, and it's important. You know, rental yield, which you normally mark to market every year in terms of, okay, how much income am I getting from the property and what is the market value of that property expressed as a percentage. And it's an important measure because you're really working out, you know, how hard is that asset working for you, and then you add the long-term capital growth together with it for your overall investment return. However, from a cash flow perspective, the current rental yield doesn't really matter because obviously when I buy a property today, I borrow to purchase that property. My biggest expense is interest. And that's not going to change. The market value of my property changes, but how much I borrowed when I initially purchased it doesn't change. So the rental growth on the property, even if the yield is compressing, doesn't really worry me too much and shouldn't worry investors because from a cash flow perspective, at least you're still getting more income. And so what we hope then is that because the interest cost is going to stay the same, the rental amount that you're getting per week will gradually increase year on year on year after a long period of time. And that's how a property eventually starts to pay for itself because its rental income starts to become more than its interest cost. It's really just the amount of time that might take to achieve that. But you're bang on. I think if you've got a property that's going to be in high demand from people that can afford to pay more, you know, can afford to pay more than the average, then you're going to be in a position where you can enjoy a little bit more rental growth.
A couple of minutes ago, you mentioned about higher yields in the 80s, and I remember those well. But I was also happy when my interest rate was below 10%. If it became less than 10%, I thought I was winning. So over the last couple of decades, interest rates have continuously dropped. I mean, they went to wartime type levels during COVID, and they've gone up again, but they're probably on their way down now. How important are interest rates going to be when looking at these sort of factors of break-even points?
Well, we only have to look back a couple of years ago when people were fixing their interest rates for 2%. I've still got one of mine left. It's 2.5%. It comes off in, I think, this month, in fact, which is a shame. But when interest rates were 2%, you know, almost everything was positive cash flow. It was a good sort of time in the market. So interest rates are very important. And that's why it is important to project forward your cash flow longer term, because as I say, when we're working and we've got employment income, we can weather the storm in terms of changes in interest rates. But when we're retired, we're solely then relying on the capital value of our investment funds and obviously investment income to pay for those expenses. So we don't want to be sensitive to changes in interest rates. So I tend to think a good long-term average is 6.5%. That's what I would do my numbers on. Of course, the interest rates are about that level at the moment, a little bit above, but we're at restrictive settings. And of course, we're expecting that to change next year in terms of some interest rate reductions. But we're looking at the long-term average here. And that's why you're going to have periods in retirement where interest rates are higher than average. You just don't want to be in a situation where that's going to end up costing you a lot of money because that's when you can least afford it.
I think all this also points to the importance of planning and using the right sort of software to get an idea of what your total costs are going to be. That also means you've got to have buffers in place to cover unexpected costs because they always come up. But how important are tax breaks, tax benefits, negative gearing, those sort of factors in the overall equation? I know you looked at this in great detail a number of years ago. Was it 2019 when, before the election, they were talking at that stage about removing negative gearing and capital gains tax?
It doesn't change whether borrowing to invest in property is a good strategy or not. It still works with or without the gearing. Now, of course, the gearing just helps. It means that I'm putting less money into the property to fund its holding costs. And using the example that I used previously, if it's going to cost me $400,000 to hold the property over the next 20 years, it probably won't, by the way, because you would expect that to decline. Then if I don't get a tax deduction, well, maybe it's going to cost me $600,000. But as long as that property's, got $4, $5, $6 million of capital growth over that period of time, which is not unrealistic, it's still going to work. But the negative gearing benefits are actually more important than the capital gains tax liability. So that is when people think about, how do I structure myself to minimize tax? Of course, they're the two taxes you really want to think about, as well as land tax you might throw into the mix as well. But not compromising on benefiting the most from negative gearing is the most important thing, even if that gives rise to potentially a little bit more capital gains tax in the long run. It's okay. Negative gearing is the more important factor. And the reason for that, obviously, it does defray some of the holding costs, a large proportion of the holding costs, hopefully. And it's a benefit I receive today, whereas capital gains tax I might pay in 20 or 30 years' time. It could be a big amount, but it's going to be in 20 or 30 years' time. A dollar today is worth more to me today than in 20 or 30 years' time, of course.
If you set yourself up right, you may never have to pay the capital gains tax because you hold your properties in the long term. I think along the way also effective property management, proactive property management is important to ensure your investments give you maximum return and minimum headaches, Stuart.
100%. So what I said at the beginning of the episode today, Michael, was, let's focus on making the perfect acquisition. And then post-acquisition, our focus, which is primarily buy something that's going to have the highest average capital growth rate over the next 20 to 30 years. But once you've done that, your frame of mind should then turn, because once you bought the property, it is what it is. It's going to deliver the certain amount of capital growth. Then it's about minimizing holding costs as much as possible. So we want to then be proactive as investors, property investors, and ask ourselves, are there any improvements that we can make to the property that are not only going to enhance its capital value, but then also enhance its income profile, and or reduce the probability of the property being vacant for any period of time, hopefully. So sometimes investors are reluctant to spend money on their properties. They feel like, well, if I avoid doing it, it's money saved. But it's not really, because you're going to either take a haircut when you sell the property because, you haven't kept up the maintenance and it's in disrepair, or you'll take a haircut on the rental income, or perhaps both. So maintenance and improvement can't be avoided. It can only be delayed. You're going to have to pay the piper at some point. So the way then I think about it, certainly from my own properties and my clients' properties, is great. We've bought this asset. We've spent most of the money on land value. Unfortunately, the rental yield's quite low. But what can we do to this asset to enhance it? And quite often, you can make some cosmetic renovations, bathroom, kitchen, do the flooring, maybe some window furnishings, paint the place. Has a dramatic impact for a relatively low cost. I don't want to be flagrant. There's a cost there, of course, but relative to the capital value of the asset, it's not substantial. The benefit, though, is, okay, I've outlaid $100,000 to renovate my property. The benefit is, though, I haven't actually outlaid the $100,000. I've gone and borrowed it. So it's just the additional interest cost, which is tax deductible. But then the other benefit is I get the depreciation benefits as a result of making those, and they're non-cash expenses, of course. So I'm going to get better tax benefits from my asset. And they're the sorts of things I think people need to start thinking about in terms of changing the income profile of their properties. And ultimately, that means I need to put less money into this investment. So I'm increasing my internal rate of return, the investment's performance, because it's not costing me as much money each year.
It's also making your property more attractive to a wider range of tenants. Sure, at the moment, vacancy rates are at historic lows and it's not hard to find a tenant, but that situation is going to change as the cycle moves on also. So I like the idea of manufacturing capital growth in your property and rental growth by doing renovations. Now, I want to get some advice from you for investors who are struggling with this long wait. But before I do, a couple of times you've mentioned about your clients. So maybe you could just help give us an idea of what you and your team at Prosolution Private Clients do. I'm going to leave a link in the show notes to that, and of course to your great Investopoly blog and podcast. But how do you help clients?
Well, we believe that lots of decisions we make are multifaceted, and property investing is a perfect example. There's some financial planning considerations, retirement planning, taxation, borrowing, cash flow, all these sorts of things. Because they're multifaceted, they really should be dealt with using a multifaceted approach, which is exactly what we do. So we believe that taking a holistic approach, having a mortgage broker, an accountant, and a financial advisor sit in the room and talk about a client situation, which is what we do every week within a team environment, is the best way to solve the problem, because we maximize all the opportunities and minimize all the risk, and then help them over time to obviously achieve their goal, which for most people is to have a very comfortable and enjoyable retirement.
Now, Stuart, some people are going to be listening to this or watching this podcast and thinking, yeah, that's all very well for them to say, but I actually am struggling a little bit with the cost of living. It's not all working out for me. They're struggling with this wait. They can't wait 25 years, like you said. Really? If I knew that, I wouldn't have got into this. How can they stay focused on the long-term benefits when the short-term cash flow feels tight?
I think it's about using good long-term planning and long-term averages. And the answer is that when interest rates were low, we should have been preparing for periods of time where interest rates are higher than average, which is what they are today, of course. So during times when interest rates are higher, it's okay then to rest on some cash flow buffers, some savings and so forth to get you through that period. Interest rates won't stay high forever. In fact, when you look at it in terms of interest rate movements, they tend to move very quickly, either up and both down. So interest rate settings can change very quickly. You want to build in buffers into your loan, just in case something changes with the property or you need to do some maintenance, or to accommodate a tighter sort of cash flow position that can occur not only just because of interest rates, but it can be circumstantial as well. Like young families, when they have children, of course, their expenses are higher. Childcare is ridiculously expensive. Their income can be lower, if someone's on maternity or paternity leave. So you want to get through those periods of time, and it's just about planning, I guess, scoring away a little bit more money when interest rates are lower than normal, and then having those buffers to rely upon, both from a lending perspective and a cash flow, cash savings perspective when interest rates are a little bit higher. If they're struggling at the moment, they don't have those buffers, well, they need to think about, what will it look like next year? And if that will solve the problem, like if interest rates dropping 1% will put them back into a better position, well, they just need to kind of ride it out. But if they've got to a point where, unfortunately, maybe through a wrong decision making, they've borrowed too much or their situation has changed, well, you might need to make more permanent, longer term changes to your borrowing profile as a result of any of those changes.
It's probably not going to give people a lot of comfort, but my opinion would be if you do the hard things now, you're going to have an easier life later. But if you do the easy things now, you're likely to have a harder life later. Who knows what sort of pension is going to be available? I recently had a look at what average superannuation balances are, and it's not going to be a pretty sight for most Australians when they retire. And who knows what the government's going to do about allowing you to use your superannuation when you can. We know between now and then, so many things are going to change. So in my mind, an investor's job is to build as big an asset base as they can so that in the future they have choices, Stuart.
And we've spoken about how property should behave, or property portfolio should behave when you go into retirement. And I said we don't really necessarily want a lot of income from the property portfolio. So then it's natural to think, well, okay, Stuart, then how's it all going to work? Well, the way I see property typically behaving in an investment strategy is it underpins all your other assets. What it does is mitigate that longevity risk that you end up spending all your superannuation or whatever other investments you might have. So if you're in a position where you go, well, I'm going to have a reasonable super balance by the time I retire, but I don't think it's going to be enough. Well, then investing in property today, getting that property portfolio to be neutrally geared by the time I enter into retirement, and then kind of you're thinking about funding retirement in two phases. The first phase then is funded by your superannuation, and when that not runs out, but when the balance gets uncomfortably low, that's when you can go and sell your property assets to replenish those monies again. So that the benefit of taking that approach is it then allows you to be able to hang on to that asset for multiple decades, hopefully 2, 3 or 4 different decades over that time. And that's when the power of compounding capital growth really kicks in. And it will be in 40 years' time that you'll look back and go, gee, I should have bought an asset that had a higher capital growth rate, because the differential, even a 1% differential over such a long period of time, is huge in terms of numbers. And also, if you are in retirement and you can see your super balance decreasing each year because you have to take a lot of money out to pay for living expenses, you're not going to be too worried about that if you've got this massive compounding property portfolio. If on average your properties are rising by $200,000, $300,000, $400,000 a year, and you're dipping into your capital in super, you're not going to be too worried about that.
Well, I guess it all starts by planning to become the people you plan to become. And that's why I know your team at Prosolution and ours at Metropole start off with a plan, and the property you eventually buy should be the physical manifestation of a whole lot of decisions you make based on those plans. I look forward to chatting again with you next month. So I guess the lesson is be patient. I think Warren Buffett wisely said, wealth is the transfer of money from the impatient to the patient, Stuart.
Yep, spot on. And another one of his saying is someone sitting in the shade because someone planted a tree 30 years ago. So you want to be sitting in the shade in 30 years' time having a really enjoyable retirement.
Fantastic. Thanks for your time today, Stuart.
Thanks, Michael. Being fun.
I always enjoy my chats with Stuart Wemyss, and I guess one of the take-home messages is plan to become the person you plan to become, because property investment's a long-term game. Now, before I share my mindset message with you, I want to remind you that once a week I have another podcast, Demographics Decoded, with leading demographer Simon Kirstenmacher, where we unveil the trends shaping our futures. It's an important podcast for anyone who's interested in property, in business and entrepreneurship. So why not just stop for a second on whichever podcast player you're listening to this, or if you're watching this on YouTube, just search for Demographics Decoded and subscribe so that once a week you get the great information from Simon and me and our guests. Now, before I share my mindset message with you, I want to just remind you of a great saying by Warren Buffett. He said, somebody's sitting in the shade of a tree today because somebody planted a tree a long time ago. I guess I've found that property investment is boring. Well, it should be boring. Look, sure, everyone likes to hear the stories about the 25-year-old who created a tech startup and made millions, or you see them on Instagram or Facebook or TikTok all the time. Somebody was flipping hamburgers last year and this year's flipping properties. But in reality, for the vast majority of us, investment is boring. Actually, let me say that differently. Property investment should be boring. A solid investment strategy should be as interesting as watching grass grow, or in Buffett's analogy, a tree grow. Planting a tree is a long-term bet. You don't plant a tree and expect shade tomorrow. But if you plant the right seeds in the right conditions, sooner or later, time will work its magic and you'll have a tree. And it's the same with property investing. There's no quick fix when it comes to building or growing your wealth. It's about planning. Planning first and then doing something. However, now is the right time to plant for your future seasons, the future seasons of your financial life. And if you're looking to use the same team I do to plan for your financial future, why not have a chat with my team at Metropole? There'll be a link in the show notes, or go to metropole.com.au and have a complimentary wealth discovery consultation with one of our wealth strategists. And this is just as relevant if you're a beginner looking for a time-tested property investment strategy or an established investor who's stuck, or maybe you just want an objective second opinion about your situation. We'll help you by showing you how you can get a strategic property plan, helping you plan to become the investor you plan to become, helping you plant the trees to give you shade in your future. Metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to remind you that the world doesn't owe you anything. Look, as I got older and wiser, I think there's a real problem going around the world today. I may offend some people, but I feel too many people are walking around with a general sense of entitlement. And in my mind, that's damaging. The truth might hurt, but the world doesn't owe you anything. Now, that may sound harsh, but accepting that truth is essential in maximising your personal development and your financial situation. The sooner you take responsibility for yourself and stop relying on others, like the government or your employer, to take care of you, the sooner you take control of your own financial future. Depending upon your background and perspective, this concept may sound scary. I'll tell you, it's not nearly as scary as hoping your employer is going to show you loyalty when the market changes, or that you'll be paid what you're worth even when things go well. That's a mirage, and it's not at all secure. One of the most powerful things that will happen when you accept that no one's going to take care of you financially is that you're going to become more motivated to do something. You begin to look closer at your financial situation. You start to notice your budget, how much you earn, how much you spend, and how much you pay in taxes, what your expenses are. You start taking responsibility. I know that was the case in my life, and I hope you start thinking the same way too. So why this sense of entitlement? I think this new sense of entitlement is partly because of the cushy way in which children have been raised for the past few decades. Now, I told you I'm going to offend some people, but when you consider that we live in what's been regularly ranked as the wealthiest country in the world, it was surprising to find that half our nation receives government benefits of some sort. Now, I'm all for helping those in genuine need by giving them a hand up. I've always supported a range of charities for the needy, but it seems that today there are more people not doing their share, waiting for those that do their share to provide for them. In essence, they feel the world owes them something. In fact, many people operate on the assumption that the world owes them a hot meal, a bed to sleep on, shoes, smartphones, anything else they simply want just because they exist. Today, some people do not want to work. And if they do work, they don't want to work too hard. Nor do they want to work in jobs that they see as beneath them or aside from their personal interests. Call me old-fashioned, but I see children getting trophies just for showing up, lest we hurt somebody's feelings by admitting that one child is better than another. Children are not allowed to fail. We can no longer separate the intelligent from the less intelligent and are forced to make sure that every person fits into the same mould of life. The world has a bullying problem that can no longer be solved by playground brawls. Now, I'm not suggesting they are a good idea, but in my mind, in many ways, many people today are living their lives as victims because of this. They're giving up the right to choose, to succeed, to create their own destiny by sitting back and waiting for the scrappy handouts that are left behind. And then, with audacity, these same people feel they've got the right to complain about what they were given. The problem of entitlement is not the one that's going to go away anytime soon. The truth is that people need to realise that it's we who owe the world. We owe the world our talents. We owe the world our skills. We owe the world our ability to take care of our planet. We owe the world our efforts to make the planet a happier, safer place. And in my mind, until each and every one of us can get together and realise that within us, big and small, white, black, coloured, male or female, rich or poor, and again, I'm not trying to offend anybody, within all of us lies a responsibility to the world. Until we accept that, in my mind, things are going to only get worse. Now, I told you at the beginning of this mentorship message, I may offend some people, but I just wanted to tell you how I felt, just based on a conversation I had with somebody just recently. I'd heard of somebody who is definitely able to work, but actually is on the pension, on the dole, saying they can't work, but then doing a whole lot of jobs on the side for cash and not paying any taxes. That's what motivated me for this little rant. Thanks for listening. Thank you for spending the last little while with me. I hope you got some benefit from today's show. But before you move on to the next podcast you're hoping to listen to, please let me remind you that I have one other show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where we unveil the trends that are going to shape your future. Now, in my mind, this is a must-listen-to podcast for anyone interested in property investment, business or entrepreneurship. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your favourite podcast app, wherever you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, please click the follow or subscribe button where you're listening right now, so that twice a week you'll get the benefit of the information from my guests and me. I've got a little favour to ask you. If you did enjoy today's show and you know somebody else who may benefit, please tell them about the Michael Yardney podcast and Demographics Decoded as well. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player, or just talk to them, tell them about this podcast. I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in helping me in my quest to make as many people as possible financially literate. Oh, by the way, I've got a special bonus for you to say thank you for subscribing to the show. Just go to podcastbonus.com.au. I'll leave a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports to help you. My way of saying thank you for taking the time to listen. And of course, if you haven't listened to the many other episodes we've already published, you can always listen to the old episodes, which each have their own lessons on property investment, success and money. But of course, the information we share in all these is general information, not specific advice. But if you're looking for specific advice, you can always speak with my team at Metropole. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?